Everyone around you is scared right now. They're watching their portfolios bleed. They're reading the headlines. They're cutting budgets, freezing hiring, pulling back, waiting for someone to tell them it's safe to move again. And then there's another group. They're not on the news. They're not posting about it. They're not panicking. They're shopping. Because here's what that second group understands that the first group doesn't. An economic crash is not a disaster for everyone. For the prepared entrepreneur, it is the single greatest wealth transfer event of their lifetime. And today, I'm going to show you exactly why and exactly how they think. Welcome back. If this is your first time here, this channel is built for entrepreneurs who want real financial intelligence, not motivational noise. What I'm about to break down has been true through every crash in modern economic history: 1929, 1987, 2000, 2008, 2020. The pattern never changes, only the players do. Subscribe if you want to be one of the players who understands the pattern. Reason number one: everything goes on sale. Everything. When an economy crashes, asset prices collapse across the board. Real estate, equipment, commercial leases, businesses themselves, talent, advertising, raw materials. For the consumer, that's devastating. For the entrepreneur with cash reserves and clarity, that's a clearance sale on the building blocks of wealth. Think about what Warren Buffett did in 2008 while banks were nationalizing and markets were in free fall. He deployed $5 billion into Goldman Sachs at terms he could never have negotiated in a healthy market. He didn't wait for the bottom. He moved when others couldn't. The principle is ancient. Buy when there's blood in the streets, even if some of the blood is yours. The entrepreneur who holds cash through a boom and deploys it through a crash doesn't just recover, they leapfrog everyone who froze. Price resets are not accidents of crashes. They are the primary feature, if you're positioned to use them. The insight? A crash doesn't destroy value. It transfers it from the unprepared to the prepared. Reason number two: your weakest competitors disappear. This sounds ruthless. It isn't. It's economics. Every industry carries a significant percentage of businesses that are only surviving because conditions are favorable. Low interest rates are covering their debt. Cheap credit is masking their inefficiency. Strong consumer spending is hiding their weak margins. When a crash hits, that cover disappears, and those businesses close. During the 2008 recession, over 170,000 small businesses shut down in the United States alone. During the 2020 collapse of the restaurant industry lost nearly 1 in 6 locations permanently. For the surviving businesses and for new entrepreneurs entering those markets, the competitive landscape just got dramatically cleaner. Less noise, less price competition, more available talent, more available customers who now need a new provider. The crash didn't shrink the market, it restructured it. And the entrepreneurs still standing after the restructuring own a larger piece of a market that will eventually return to full size. The insight? Every competitor that closes is a customer base looking for a new home. Be that home. Reason number three: the talent pool floods and the best swimmers rise to the top. In a booming economy, great employees are locked up. They're comfortable. They have options. Recruiting them costs a fortune and takes months. Startups and small businesses simply can't compete with the compensation packages that large corporations offered during good times. A crash changes that equation completely. Large companies, the first to do mass layoffs when earnings drop, release thousands of experienced, skilled, highly motivated professionals into the job market simultaneously. Engineers, marketers, operations managers, financial analysts, people who would have laughed at a startup offer 6 months ago are now genuinely open to something new. The entrepreneur who is hiring during a crash, even modestly, has access to a caliber of talent that would have been completely out of reach 12 months earlier. And those employees, hired during hard times, treated well, given equity and ownership, become the most loyal, highest performing teams in the industry. Microsoft, Apple, Disney, all made some of their most consequential hires during economic downturns, not despite the crash, because of it. The insight? Recessions are the greatest recruiting events in business history. Hire when everyone else is firing. Reason number 4, operating costs hit the floor. Office space, advertising rates, manufacturing costs, supplier pricing, software contracts, agency fees. Every single one of these drops during an economic crash because every single one of these vendors suddenly has excess capacity and desperate need for revenue. The commercial real estate market during the 2008 crash saw vacancy rates spike to record highs, meaning landlords who were charging premium rents 6 months ago were suddenly offering free months, build-out allowances, and flexible lease terms just to keep space occupied. Digital advertising costs on Google, on Meta, on programmatic platforms drop dramatically during recessions because large brands pull their budgets. That means the cost per click, cost per lead, and cost per acquisition for smart small businesses running lean campaigns falls to some of the lowest levels of the decade. The entrepreneur that launches or scales during a crash isn't just buying assets cheap, they're operating cheap. Lower fixed costs, lower variable costs, better negotiating leverage across every vendor relationship. The unit economics of a business launched in a crash are structurally better than the same business launched in a boom. That advantage compounds for years. The insight? The cost structure you lock in during a crash becomes your unfair advantage during the recovery.
Reason number 5, necessity becomes the mother of billion-dollar inventions. Every major technological and business model innovation in the last 100 years has either been born during a crisis or turbocharged by one. The Great Depression produced industrial efficiency innovations that defined American manufacturing for decades. The dot-com bust of 2000 cleared out the noise and left Google, Amazon, and PayPal standing. The 2008 crash accelerated the sharing economy. Uber, Airbnb, and Lyft were all founded between 2008 and 2009. Why? Because crashes force problems to the surface that comfortable markets allow people to ignore. And entrepreneurs, by nature, are problem solvers. When consumers are broke, they need cheaper solutions. When businesses are cutting costs, they need more efficient tools. When institutions fail, they create gaps that nimble startups can fill faster than slow-moving incumbents can respond. The crash doesn't just create opportunity, it creates urgency. And urgency, combined with a prepared mind, is the formula that has produced every generational company you can name. The insight? The companies built to solve crash-era problems become the dominant platforms of the recovery era. Reason number 6, money gets cheap for those who know how to access it. Central banks respond to economic crashes with the same playbook every single time. They cut interest rates aggressively to stimulate borrowing and economic activity. What this means in practical terms for the entrepreneur, the cost of borrowing money to start or scale a business drops significantly during and after a crash. The Federal Reserve cut rates to near zero following the 2008 crash and held them there for 7 years. Entrepreneurs who accessed SBA loans, business lines of credit, or investment capital during that window built businesses on some of the cheapest debt in American history. Beyond interest rates, distressed asset lenders, private equity looking for deployment opportunities, and angel investors who want to buy in at lower valuations are all actively hunting for deals during crashes. The smart entrepreneur doesn't hide from that capital. They learn to speak its language and access it. Money doesn't disappear during a crash. It moves, and it moves toward the prepared. The insight? The crash lowers the price of capital at exactly the moment it lowers the price of assets. That combination only comes around once or twice in a generation. Reason number 7, the relationships and loyalty you build during a crash last a lifetime. This is the reason smart entrepreneurs don't just tolerate crashes, they genuinely value them. When you show up for a customer during the hardest economic moment of their life, when you extend terms, when you don't raise prices, when you find a way to keep serving them when everyone else pulled back, that customer doesn't forget. When you hire someone during a recession and give them a real opportunity when the market told them they had none, that employee doesn't forget. When you pay your suppliers on time during a crash, when your competitors are stretching payments to 90 days, that supplier doesn't forget. The goodwill built during a crash is worth more than any marketing campaign you could ever run. It converts into loyalty that survives the next boom, the next competitor, the next disruption. The brands that people stayed loyal to through the COVID collapse, the ones that were honest, human, and present, came out of that period with customer relationships that no amount of advertising spend could have purchased. The insight? A crash is not just a financial event, it is a character test. Pass it, and your business earns something money cannot buy. Here's what I want you to take away from everything I've shared today. Fear is the price of admission to every great opportunity in history. The people who changed industries, built generational wealth, and created companies we still use every day, they were scared too. They just didn't let the fear make the decision. The crash is happening whether you participate or not. The only question is which side of it you end up on. If this shifted your perspective, share it with one entrepreneur in your network who needs to hear it right now. Drop in the comments, are you in fear mode or opportunity mode? I want to know where you're at. Like, subscribe, and I will see you in the next one.